Hello, real estate lovers. Welcome back to the channel. In this video, we're tackling 54 practice questions for Chapter 14, Interest Rates and Mortgages from the UBC Real Estate course. Whether you're preparing for your exam or just want to master this topic, these questions will help you boost your confidence and improve your understanding. So grab your notes and let's get started. Chapter 14, Question 1. A borrower is arranging a mortgage with Nicety Finance Company. The loan amount is $175,000. The interest rate is 4.5% per annum, compounded semi-annually. The amortization period is 20 years, and the contractual term is 2 years. If payments are made monthly and rounded up to the next higher $10, calculate the outstanding balance at the end of the loan term, rounded to the nearest dollar. Step 1. Since the payment frequency and compounding frequency do not match, we'll use NPN as a simple abbreviation to help you remember this easily. Point 5. Shift NOM. 2. Shift PYR. Shift effective. 12. Shift PYR. Shift NOM. Calculator displays J12 equals 4.4583%. Now let's find out the outstanding balance. 240 N. 12 monthly payments times 20 years amortization period. IYR, already entered in the first step. 1,110 PMT plus and minus sign, entered as negative for outflow. 175,000 PV loan amount, 0 FV. PYR, already entered. Now we use the amortization function to determine the remaining balance after 24 months. The outstanding balance is the present value of remaining payments after 24 months. Enter 24 input shift amort. Calculator will display per 2424. Press equal sign 3 times. Calculator displays 163,479.72977. The outstanding balance owing at the end of 24 months is $163,480. Thus, the correct is C, $163,480. Question 2. A $195,000 mortgage loan has an interest rate of 7.5% per annum, compounded monthly. At the end of its 5-year amortization and term, the borrower will owe $178,877.95 on the loan. What is the amount of each monthly payment? At the end of the term, the borrower will owe an outstanding balance of $178,877.95. Set this number equal to the FV and then calculate the payment. 60 N 5 years times 12 monthly payments. 75 IYR PMT we need to calculate. 195,000 PV loan amount 178,877.95 plus and minus sign then FV. 12 shift PYR. Press PMT. The calculator displays 10441.039997. The monthly payment is $1,441.04. Question 3. What will be the purchase price of a mortgage that will provide the buyer with 48 payments of $650 plus an outstanding balance of $55,858.13 at the end of 48 months if the buyer of the mortgage requires an effective annual yield of 15%? Round your answer to the nearest dollar. Step 1. Let's convert the given J1 equals 15% to J12. 15, shift NM, 1 shift PYR, shift effective 12, shift PYR, shift NOM, calculator displays J12 14.579. Step 2. Let's figure out the purchase price of this loan, so solve for PV 48, months amortization period, IYR already entered, PMT 650 plus and minus sign, 55,858 plus and minus sign, PYR already entered. Press PV calculator display 55,698.259135. The purchase price of this loan will be $55,698, rounded to the nearest dollar. Question 4. An investor wants to decide whether to buy a mortgage that calls for monthly payments of $390 for 20 years. If the investor can earn J2 equals 8% in other investments, at what price should the mortgage be purchased, rounded to the nearest dollar? The question is looking to find the present value of the mortgage from the given terms. Step 1. Let's convert the J1 8% to J12. 8, shift NOM. 2, shift PYR, shift effective. 12, shift PYR, shift NOM. Step 2. Solve for PV. 240 N, 12 months times 20 years amortization period. IYR already entered. 390 plus and minus sign PMT FV PYR already entered. Press PV, calculator displays 47,081.12383. The investor should purchase the mortgage for $47,081 to earn J2 equals 8%.
Question 5. Which of the following is true if borrowers make accelerated biweekly payments on their mortgage loan? Option 4 is correct because the accelerated biweekly payment is calculated as the monthly payment divided in half. Instead of paying once a month, 1/2 of the monthly payment is paid every 2 weeks. Since the effect of the accelerated biweekly payments allows the borrower to make the equivalent of one extra monthly payment, the borrower will pay less interest over the loan and make a larger number of payments in a calendar year than with a constant monthly repayment schedule. Option 1 is incorrect because the borrower will make more monthly payments in a calendar year than a borrower who makes constant monthly payments. Option 2 is incorrect because the borrower will pay less interest over the life of the loan than a borrower who makes constant monthly payments. Option 3 is incorrect because the borrower pays 1/2 of the monthly payment every 2 weeks. This amounts to 1/24 of the annual payment, since 1/12 of the annual payment is equivalent to the monthly payment. Question 6. Which of the following is true regarding an effective annual rate of interest of 10% per annum, compounded semi-annually? Correct answer: it is less than the effective annual rate for 9.9% per annum, compounded daily. Calculate the effective annual rate of interest of 10% per annum, compounded semi-minus annually, and the effective annual rates of interest for each option. 10 shift NOM, 2 shift PYR. Shift effective. Calculator displays J1 equals 10.25. Option 1. 9 shift NOM, 2 shift PYR. Shift effective. Calculator displays J1 equals 9.2025. Option 2. 10% per annum compounded annually equals 10% effective annual rate. Option 3. 10 shift NOM, 12 shift PYR. Shift effective. Calculator display J1 equals 10.471307. Option 4. 9.9 shift NOM, 365 shift PYR. Shift effective. Calculator display J1 equals 10.405148. Therefore, option 4 is correct. Chapter 14. Question 7. With fully amortized constant payment mortgages, when payments are rounded up to the next higher cent, the final payment necessary to repay the loan amount will be which of the following? Correct answer is A, smaller than the regular payments. Option 1 is correct because if the payment is rounded up to the next higher cent, the final payment of a fully amortized mortgage will be smaller than regular payments because the borrower is overpaying a slight amount each period. Options 2, 3, and 4 are incorrect for this reason. Question 8. A $170,000 mortgage loan, written at a nominal rate of 7% per annum, compounded semi-annually, has a 2-year contractual term. Payments are made monthly and are based on a 20-year amortization period. Payments are rounded to the next higher dollar. What is the size of the required payments? Step 1. Let's convert J2 equals 7% to J12. 7 shift NOM, 2 shift PYR. Shift effective. 12 shift PYR. Shift NOM. Find the payments, rounded up to the nearest dollar based on the terms of the mortgage contract that are given in the question. 240 N 12 months times 20 years amortization period. IYR already entered. 170,000 PV. PMT we need to calculate. 0V. PYR already entered. Press PMT to get the monthly payment rounded up to the next higher. Dollar is $1,308. Question 9. A borrower wishes to make monthly payments of no more than 30% of their monthly income of $2,500 for a period of 200 months. The interest rates are currently 9% per annum, compounded. Semi-annually, what is the maximum amount that should be lent, rounded to the nearest dollar? The borrower's maximum monthly payments are to be 30% of his $2,500 monthly income. In other words, the borrower's maximum monthly payment will be $750, $2,500 times 0.3. Then, calculate the maximum amount lent, which is the PV of the monthly payments. Let's convert the given semi-annual payment, which J2 equals 9%, to monthly payment J12. 9 shift NOM, 2 shift PYR. Shift effective. 12 shift PYR. Shift nom. Calculator display, J12 equals 8.835748. Now solve for PV. 200 N, amortization period. IYR already entered. 750 plus and minus sign PMT. 0 fee. PYR already entered. Press PV to calculate the maximum amount lent. The calculator will display PV equals 78,374.008924. The correct answer is D, $78,734. Question 10. A mortgage loan has a face value of $300,000, an interest rate of J2 equals 4%, an amortization period of 25 years, a term of 5 years, and an option to make accelerated biweekly payments rounded up to the next highest dollar. If this option is exercised, what is the outstanding balance owing at the end of the 5-year term rounded to the nearest dollar? Step 1. To solve for the outstanding balance owing at the end of the term, first determine the monthly payment under the loan. Take 1/2 of that monthly payment as the accelerated payment. Then change the interest rate to an equivalent J26 rate, and using 1/2 of the regular monthly payment, solve for the outstanding balance at the end of the term. Now let's convert given the semiannual payment to monthly payment. In other words, convert J2 equals 4% to J12. 4 shift nom. 2 shift PYR. Shift effective. 12 shift PYR. Shift nom. The calculator displays J12 equals 3.967068. Step 2. 300 N, 25 years times 12 monthly payments. IYR already entered. 300,000 PV. 0 fee. PYR already entered. Press PMT, calculator displays minus 1,578.06062. Divide by 2 is equal to minus 789.03031. 790 plus and minus sign PMT to the round payment. Now let's find out our accelerated biweekly payment, which is J26. 4 shift nom. 2 shift PYR. Shift effective. 26 shift PYR. Shift nom. Calculator displays J26 equals 3.963543. Final step, let's find out the outstanding balance at the end of 5-year term based on the question. So in 5 years we had 26 payments, which is 5 times 26 equals 130. Press 1 input 130 shift amort. Calculator displays amort per 1 to 130. Press equal sign 3 times to find the outstanding balance owing at the end of 5-year term. Calculator displays 252,210.347253. So the correct answer is D, $252,210. Rounded to the nearest dollar. Question 11. Alexander Management Company Limited has just arranged a $1,450,000 mortgage loan to finance their purchase of a small retail shopping complex. The interest rate is 12.75% per annum compounded semi-minus annually. The amortization period is 20 years and the term of the loan is 10 years. Payments are to be made quarterly and rounded up to the next higher dollar. Which one of the following statements is false with regard to this contract? Option 3 is false statement, thus the correct answer here. Individual borrowers, not corporations, have the right, under the terms of the Interest Act, to prepay all of the outstanding balance at any time after 5 years from the initiation date of the mortgage. The calculations for options 1 and 2 are as follows. Option 1, solving for payment. 12.75 shift nom. 2 shift PYR. Shift effective. 4 shift PYR. Shift nom. Calculator display J4 12.53027. 1,450,000 PV. 80 N. 20 years times 4/quarterly payments. 0 fee. Press PMT calculator display minus 49,700.134749. Payment is $49,701 rounded to the next higher dollar. Option 1 is true. Option 2, to solve the outstanding balance at the end of the term 10 years, Enter the rounded payment and then can calculate the outstanding balance, aka OSB. The calculator steps continue as follows. For 9701 plus and minus sign PMT. 10 times 4 equals sign input shift amort. Calculator displays PER 4040. Press the equal sign 3 times. Calculator display 1,123,491.3788. This shows that the outstanding balance immediately following the 40th payment is $1,123,491.84, which is less than $1,123,500. Therefore, option 2 is a true statement. Option 4 is also a true statement. The lender has no right to demand payment of the total outstanding balance at any time prior to the end of the contractual term, provided the borrower meets all contractual obligations. Question 12. Steelgrave Developments is contemplating the construction of a large residential building. They have been guaranteed financing by their bank in the amount of $1,500,000. The terms of the financing are J2 equals 9.75% with a 20-year amortization period, 5-year term, and monthly payments. Steelgrave believes that if market conditions are favorable, they will sell the building when it is completed, 2 years from now. How much principal will be paid off at the end of the 2-year construction period, rounded to the nearest dollar? Find the amount of principal that has been paid off during the 2-year term. First, let's change the given J2 equals 9.75 to J12. 9.75 shift nom. 2 shift PYR. Shift effective. 12 shift PYR. Shift nom. Calculator display. J12 equals 9.557657. 1,500,000 PV. 240 N 20 years 12 monthly payments. 0 fee. Press PMT. Calculator displays minus 14,038.492319. 14,038.49 plus and minus sign PMT to round the payment. 1 input 24 shift amort. Calculator displays PER 124. Press equal sign. Calculator displays minus 55,071.663913. The amount of principal paid off during the 2-year term is $55,072 rounded to the nearest dollar. The correct answer is B, $55,072. Question 13. Which of the following is true regarding the effective annual rate of interest of 8% per annum, compounded semi-annually? This question requires you to compare the effective annual interest rates of options 1, 2, 3, and 4 with the effective rate of the given nominal rate. 8 shift nom. 2 shift PYR. Shift effective. Calculator displays 8.16, which is J1 equals 8.16. Option 1. 7.2 shift nom. 4 shift PYR. Shift effective. Calculator displays 7.396743. That is, J1 equals 7.396743. Option 2. 5% per annum compounded annually is equal to the effective rate. Option 3. 5 shift nom. 12 shift PYR. Shift effective. Option 4. 7.5 shift nom. 365 shift PYR. Shift effective. Calculator displays 7.787585, which is J1 equals 7.787585. Therefore, option 4 is correct. Question 14. An investor has the opportunity to invest in one of 4 alternative mortgages, each with the same degree of risk. The only distinction between these investments is the rate of interest charged to the borrower. These rates are: assuming that the investor can purchase each mortgage for the same amount of money, which investment will be preferred? Loan A, B, C, or D? Solution: find the effective rates for each of these nominal rates and compare. The investor acts as the lender and will prefer the loan with the highest interest rate. Loan A, 13.25 shift nom. 365 shift PYR. Shift effective. Calculator display 14.165157. That is J1 equals 14.165157. Loan B 13.5 shift nom 4 shift PYR. Shift effective. Calculator display 14.198945. That is J1 equals 14.198945. Loan C 13.75 shift nom 2 shift PYR. Shift effective. Calculator display 14.222656. That is J1 equals 14.222656. Loan D. Nominal rate compounded annually is equal to its effective rate, 14.25%. Based on the above, Loan D provides the highest rate of return. Question 15. Josie purchaser arranged a mortgage loan for $175,500 at 9.25% per annum, compounded semi-annually, with a 25-year amortization period and monthly payments. What is the interest cost for the first month? Step 1. Let's change the given J2 equals 9.25% to J12. 9.25 shift nom 2 shift PYR. Shift effective. 12 shift PYR. Shift nom. Calculator displays 9.076624. Step 2. Solve for payment and then figure out the interest for the first month. 300 N. 25 years times 12 monthly payments. 175,500 PV. 0 FV. Press PMT. The calculator displays minus 1,482.009161. 1,482.01 plus and minus sign PMT to round off the payment. Now let's find out interest paid in the first month. 1. Input shift amort. Calculate displays per 1. Press equal sign 2 times. Calculator displays minus 1,327.456,197. The interest cost for the first month is $1,327.46. So the correct answer is option C, $1,327.46. Question 16. A borrower has arranged a loan of $196,000 at an interest rate of 6% per annum, compounded annually over an amortization period of 15 years. What is the monthly payment required? In this question, convert the effective annual interest rate to a monthly rate, J12, and then calculate the monthly payment. 6 shift nom. 1 shift PYR. Shift effective. 12 shift PYR. Shift nom. Calculator displays 5.841061, that is, J12 equals 5.841061. 180 N, 15 years times 12 monthly payments. 196,000 PV. 0 FV. Press PMT and the calculator will display minus 1,637.176436. So the correct answer is D, $1,637.18. Question 17. With a constant payment mortgage that is written for $48,951.77 and specifies payments of $520 per month for 15 years, what is the interest rate on this mortgage, rounded to 2 decimal places? This question is solved in 2 parts. First, calculate the interest rate on the mortgage, which will be a J12. Then, convert the interest rates to the equivalent J1, J2, and J4 to see if they match any of the answers. 12 shift PYR. 48,951.77 PV. 520 plus and minus sign and then press PMT. 180 N. 0 FV. Press IYR. Calculator displays 9.797818. J12 equals 9.797818. This does not match with the J12 rate of option 1. Therefore, we must test the other options to find the correct equivalent rate. Continuing the calculator steps, find the equivalent J1, J2, and J4 rates. Shift effective. Calculator display 10.250003. J1 equals 10.250003. 2 shift PYR. Shift nom. Calculator display 10.000003. J2 equals 10.000003. 4 shift PYR. Shift nom. Calculator displays 9.878033. J4 equals 9.878033. Options 2 and 4 do not match, therefore the correct answer is option 3. Question 18. A borrower has arranged a $159,900 mortgage at J12 equals 12% with a 25-year amortization, 5-year term, and monthly payments. If all payments are paid when due, how much principal was paid off during the 5-year term? Round your final answer to the nearest dollar. Solution. Determine how much principal was paid off during the 5-year term. Step 1. Find out the monthly payment PMT. 12 shift PYR set payments per year to 12. 12 press IYR nominal monthly rate J12 equals 12%. 159,900 PV present value of the mortgage. 325 years times 12 months, which equals 300, that is our total number of monthly payments. Enter 0 and press FV, future value is 0. Press PMT to calculate the monthly payment. Calculator displays PMT equals minus 1,684.105403. Step 2. Calculate the total principal paid off during the 5-year term. Enter 1,684.11, press and minus sign, and then press PMT, rounded monthly payment set as negative. 1 input 60 shift amort. To figure out the principal paid for the first 60 payments covering 5 years. Press equal sign to display the principal paid. Calculator displays minus 6,950.905596. Result. The total principal paid off during the 5-year term is $6,951, rounded to the nearest dollar. The correct answer is B, $6,951. Question 19. When casual reference is made to the current mortgage lending rate, the common practice is to quote which of the following? Question is looking to identify the type of interest rate commonly referenced when discussing current mortgage lending rates. Explanation. Casual references to mortgage rates typically use nominal interest rates because they are straightforward and commonly quoted by lenders. These rates do not account for compounding and are easier for consumers to understand in a casual context. Options A, C, and D are incorrect because effective annual interest rates account for compounding and are not typically quoted casually. Equivalent interest rates compare rates across different compounding periods, which is not standard in casual references. Interest rates per compounding period are rarely mentioned casually as they are less intuitive for borrowers. Question 20. If payments are rounded up to the next higher dollar, the most likely result is which of the following? Question is looking to identify the most probable effect of rounding up payments to the next higher dollar in a loan repayment scenario. Option C, a lower final payment, is the correct option. Explanation. Rounding up payments to the next higher dollar results in the borrower paying slightly more than the exact required payment each period. This extra amount is applied to the loan principal, which reduces the balance faster. As a result, the final payment is smaller because the loan is paid down more quickly. Option A is incorrect because the total cost to the borrower does not increase, it may decrease slightly. Option B is incorrect because the lender's yield does not increase. Option D is incorrect because the number of payments typically remains unchanged. Question 21. An investor deposits $8,000 at the end of each year into a bank account that pays 6% per annum, compounded monthly. How much capital will the investor have accumulated at the end of 7 years, rounded to the nearest dollar? To solve this problem, first convert the nominal interest rate, compounded monthly, to an annual effective rate so that the frequency of compounding matches the frequency of the payments. Since there is no payment being made today, there is no present value in this calculation. Then, enter the payments of $8,000 and compute the future value that would be available at the end of 7 years. Step 1. Let's convert J12 equals 6%, nominal monthly rate compounded monthly, to J1, nominal annual rate. 6 shift nominal annual rate compounded monthly. 12 shift PYR, 12 compounding periods per year. Shift effective. To calculate the effective annual rate. 1 shift PYR. To ensure the correct frequency for annual compounding. Shift calculator displays 6.167781. J12 equals 6.167781. Step 2. Calculate the future value FV of the annuity deposits made at the end of each year. 0 PV. Present value is 0 since no initial deposit is made. Set N. This is the number of years. 1000 plus and minus sign PMT. To enter it as a negative amount since it's an outflow. Press FV to determine the accumulated capital after 7 years. Calculator displays 67,495.21364. The end of 7 years, the investor will have accumulated $67,495 in the account. Question 22. Which of the following statements is true regarding the term of a constant payment mortgage loan? The correct answer, B. It specifies the duration of the contractual relationship. Explanation. Term of a mortgage refers to the length of time over which the borrower is obligated to make regular payments at a fixed interest rate before renewing or refinancing the loan. Option A is incorrect because in a partially amortized mortgage, an outstanding balance payment may be required at the end of the term, but this is not true for all mortgages. Option C is incorrect because in a partially amortized mortgage, the term is shorter than the amortization period. Option D is incorrect because in the case of a fully amortized mortgage, the term would be equal to the amortization period. Question 23. A borrower has arranged a $250,000 mortgage at J2 equals 6% with a 25-year amortization, 5-year term, and monthly payments. If all payments are paid when due, how much principal was paid off during the 5-year term? Round your final answer to the nearest dollar. Determine how much principal was paid off during the 5-year term of the mortgage. Step 1. Convert J2 equals 6%, nominal semiannual rate to J12, nominal monthly rate. Enter 6, shift nominal annual rate compounded semiannually. Enter 2, shift PYR, 2 compounding periods per year. Press shift effective to calculate the effective annual rate. 4. Enter 12, shift PYR, 12 monthly compounding periods per year. Press shift to calculate the nominal monthly rate. Calculator display, J12 equals 5.926346%. Step 2. Determine the monthly payment PMT. Enter 250,000 PV, present value of the mortgage. Enter 300, press N, 25 times 12 is equal to 300. Number of months for 25-year amortization. Enter 0 FV, future value is 0. Press PMT to calculate the monthly payment. Calculator display. PMT equals minus 1,599.516559, monthly payment. Step 3. Calculate the principal paid off during the 5-year term. Enter 1,599.52, plus and minus sign, and press PMT to round off the payment. 1 input 60 shift amort. Press equal sign once. Calculator displays. Principal paid off equals minus 25,408.479189. The amount of principal paid off during the 5-year term is $25,408, rounded to the nearest dollar. Question 24. A borrower has arranged a loan of $32,000 at an interest rate of 7% per annum, compounded semi-minus annually with payments set at $1,400 per month. What is the amortization period of the loan rounded to 2 decimal places? Determine the amortization period in years rounded to 2 decimal places for a loan with monthly payments. In simple words, find the number of months necessary to amortize the loan. Step 1. Convert J2 equals 7% nominal semiannual rate to J12 nominal monthly rate. 7. Shift NOM. 2. Shift PYR. Shift effective. 12. Shift PYR. Shift NOM. Calculator displays 6.900047. So J12 equals 6.900047. Step 2. Calculate the number of payments N. 32,000 PV, present value of the loan. 1,400 plus and minus sign and press PMT, monthly payment. 0 FV, future value is 0 at the end of the loan. Press N. Calculator display 24.575695. The loan will be amortized in approximately 24 months or 2 years, which corresponds to option C, approximately 2 years when rounded to the nearest 2 decimal places. Question 25. A mortgage was written for $48,000 at an interest rate of J2 equals 8%, an amortization period of 15 years, and monthly payments. Calculate the balance owing at the end of 5 years rounded to the nearest dollar. Objective. Calculate the remaining balance after 5 years for a mortgage with monthly payments. Step 1. Convert J2 equals 8% nominal semiannual rate to J12 nominal monthly rate. 8. Shift NOM. 2. Shift PYR. Shift effective. 12. Shift PYR. Shift NOM. Calculator displays 7.869836. That is, J12 equals 7.869836. Step 2. Calculate the monthly payment. 48,000 PV, present value of the loan. 180 N, 15 years times 12 months. 0 FV, future value at the end of amortization. Press PMT. Calculator displays PMT equals minus 455.113415. Enter 455.11 plus and minus sign and press PMT. To round off the payment. Step 3. Calculate the outstanding balance after 5 years, 60 payments. Enter 60 input, shift amort to amortize for 60 payments. Press equal sign twice to review the outstanding balance. Calculator display. Outstanding balance equals 37,725. Result. The outstanding balance after 60 months 5 years is $37,725. Rounded to the nearest dollar. Correct answer B.
Question 26. Josie Purchaser arranged a mortgage loan for $75,000 at 9.5% per annum, compounded semi-annually, with a 25-year amortization period and monthly payments. What is the interest cost for the first month? Objective. Determine the interest incurred for the first month of the mortgage loan. Step 1. Convert J2 equals 9.5% nominal semi-annual rate to J12 nominal monthly rate. 9.5. Shift NOM2 Shift PYR. Shift effective 12 Shift PYR. Shift NOM. Calculator displays 931,726. That is J equals 9.31726. Step 2. Calculate the monthly payment. 75,000 PV, present value of the loan. 300 N, 25 years times 12 months. 0 FV. Press PMT. Calculator displays -645.770724. Enter 64577 plus and minus sign and press PMT. To round off the payment. Final step. Set the amortization period for the first month. 1. Input, shift amort. Calculator displays per 1 minus 1. Press equal sign twice to compute the interest cost. Calculator displays -582.328738. Result. The interest cost for the first month is $582.33. Correct answer B, $582.33. Question 27. What is the nominal rate of interest, compounded semi-annually, that is equivalent to 11.5% per annum, compounded monthly? Round your final answer to 2 decimal places. Convert J12 equals 11.5% nominal monthly to its effective semi-annual rate J2. 11.5, shift NOM, nominal annual rate compounded monthly. 12, shift PYR, 12 compounding periods per year. Shift effective. 2, shift PYR, 2 compounding periods per year. Shift NOM. The calculator displays 1117.779067. or J2 equals 11.1777967. Final result. The nominal annual rate compounded semi-annually is 11.78%. Correct answer, C, 11.78%. Question 28. Joe Carmichael borrows $11,000 at a periodic interest rate of 0.75% per month and agrees to repay $335 per month. For how many full years will Joe have to make payments? Question objective. Determine the total number of full years Joe will need to repay the loan. In this question, we need to calculate the number of payments required, N. Enter 11,000, PV. Enter 0.75 IYR. Enter 335, plus and minus sign, and then press PMT. Enter 0 FV. Press N to calculate the number of monthly payments. The display shows 41.93 months. Final step, convert the total months to full years. Total years equal 41.93 divided by 12 equals 3.49 years. Joe will make payments for 3 full years, as only complete years are counted. Result, Joe will need to make payments for 3 full years. Correct answer, A3. Question 29. On an interest-accruing mortgage, which one of the following interest rates would result in the highest outstanding balance? Identify the nominal interest rate with the highest effective annual rate, as it leads to the highest accrued interest, and therefore the highest outstanding balance. Steps to solve using HP 10BII Plus Financial Calculator. Option A. Step 1. Calculate highest effective annual rate for J12 equals 14%. Enter 14, shift NOM, nominal rate. Enter 12, shift PYR, 12 compounding periods per year. Press shift effective, calculator displays 14.9343%. That is J1 equals 14.934203%. Option B. Step 2. Calculate highest effective annual rate for J6 equals 14%. Enter 14, shift NOM. Enter 6, shift PYR, 6 compounding periods per year. Press shift effective. Calculator display 14.842523%. That is J1 14.842523%. Option C, step 3. Calculate highest effective annual rate for J4 equals 14%. Enter 14, shift NOM. Enter 4, shift PYR, 4 compounding periods per year. Press shift effective. Calculator display 14.7523%. That is J1 14.7523%. Option D, step 4. Calculate highest effective annual rate for J2 14%. Enter 14, shift NOM. Enter 2, shift PYR, 2 compounding periods per year. Press shift effective. Calculator display 14.49%. That is J1 equals 14.49%. Final results. The highest effective annual rate is option A, J12 equals 14%, resulting in the highest outstanding balance. As the number of compounding periods increases, the effective rate increases, so the more interest you will receive for an investment. Question 30. Joe Carmichael borrows $15,000 at a periodic interest rate of 0.5% per month, and she agrees to repay $450 per month. For how many full years will Joe have to make payments? Calculate the total number of full years N that Joe will need to make payments based on the given loan details. Steps to solve using HP 10BLI Plus Financial Calculator. Step 1. Convert the periodic rate to an annual nominal rate. Enter 0.5 times 12 equals 6, so the annual nominal rate is J12 equals 6%. Step 2. Input values for the loan. Press 6, shift NOM, nominal annual rate. Press 12, shift PYR, 12 compounding periods per year. Enter 15,000 PV, present value, the loan amount. Enter 450 plus and minus sign T, the monthly payment. Enter OFV, future value. Step 3. Calculate the total number of months N. Press N. The calculator displays 36.555396 months. Step 4. Convert months into years. 36.55396 divided by 12. Result, 3.46283 years. Joe will make payments for 3 full years. Correct answer, A3. Question 31. A mortgage with a face value of $288,000 and a contract rate of interest rate of 4.2% per annum, compounded monthly, calls for monthly payments of $1,780. What is the outstanding balance immediately after the 40th monthly payment has been made? Round your answer to the nearest dollar. Determine the outstanding balance, remaining principal, after the 40th monthly payment. Steps to solve using HP 10BL I Plus Financial Calculator. Step 1. Set up the calculator. 4.2. Shift NOM, nominal annual interest rate. Press 12. Shift PYR, 12 compounding periods per year. Step 2. Input loan details. Enter $288,000 PV, present value of the loan. Enter 1780 plus and minus sign and press PMT monthly payment. Enter 0FV future value. Step 3. Compute the total number of payments. Press N. Calculator displays 239.10 months. Step 4. Calculate the balance after 40 payments using Amort. Enter 40. Input Shift Amort. Press =sign 3 times to display the outstanding balance. Result: $254,950.90. The outstanding balance immediately after the 40th monthly payment is $254,960, rounded to the nearest dollar. Correct answer B, $254,960. Question 32. Dave has recently been hired at a new job and is starting to make investments with his excess income. Dave's first investment is to place $5,000 in a term deposit where it will accrue interest at a rate of 6.5% per annum, compounded annually. The term of the investment is 18 months. How much money will Dave receive from the investment at the end of the 18-month term? Round your answer to the nearest dollar. Determine the future value, FV, of the investment after 18 months using the effective monthly rate. Steps to solve using HP 10B II plus financial calculator. Step 1. Convert the annual nominal rate to monthly compounding. Enter 6.5, Shift NOM, nominal annual interest rate compounded annually. Press 1 Shift PYR, 1 compounding period per year. Press Shift Effective to confirm the effective annual rate. Enter 12, Shift PYR, 12 monthly compounding periods per year. Press Shift NOM. Calculator displays 6.31433% as the equivalent nominal monthly compounding rate. Step 2. Input investment details. Enter 5,000 plus and minus sign and press PV, initial deposit as a negative value. Enter 0 PMT, no periodic payments. Enter 18N, investment term in months. Enter 0 PMT. Step 3. Determine the future value, FV. Press FV. Result: $5,495.338081. Correct answer, C, $5,095. Result: the amount Dave will receive from the investment at the end of the 18-month term is $5,495, rounded to the nearest dollar. Question 33. A mortgage was written for $176,000 with an interest rate of J2 equals 6.5%, an amortization period of 15 years, and monthly payments. Calculate the outstanding balance owing at the end of 5 years, rounded to the nearest dollar. Determine the outstanding balance of the mortgage after 60 months, 5 years, of payments. Step 1. Convert J2 equals 6.5% to a nominal monthly compounding rate J12. Enter 6.5, Shift NOM, nominal semi-annual rate. Enter 2 Shift PYR, 2 compounding periods per year. Press Shift Effective. Enter 12 Shift PYR, 12 monthly compounding periods per year. Press Shift NOM to find the equivalent nominal monthly compounding rate. Calculator displays 6.41388%. J12 equals 6.41388%. Step 2. Calculate the monthly payment. Enter $176,000 PV, loan principal. Enter 180 N, 15 years times 12 months. Enter 0 FV, fully amortized loan. Use 6.413688 IYR, nominal monthly rate. Press PMT. Calculator displays $524.813. Monthly payment. Enter 1524.81 plus and minus sign, PMT, to round off the payment. Step 3. Calculate the balance after 60 months. Enter 60. Input Shift Amort, amortization for first 60 payments. Press =sign 3 times. Calculator displays 134,808.579554. The outstanding balance after 60 months is $134,809, rounded to the nearest dollar. Correct answer D, $134,089. Question 34. A local builder negotiates an interest-only loan with ABC Finance Company. The face value of the loan is $450,000. The interest rate is J2 equals 8%. The term of the loan is 3 years, and the interest-only payments are to be made monthly. What will be the size of the monthly interest-only payments? Calculate the monthly payment for an interest-only loan, which is derived by multiplying the loan principal by the monthly periodic interest rate. Step 1. Convert J2 equals 8% to a nominal monthly compounding rate J12. Enter 8, Shift NOM, nominal semi-annual rate. Enter 2, Shift PYR, 2 compounding periods per year. Press Shift Effective. To calculate the effective annual rate, enter 12, Shift PYR, 12 monthly compounding periods per year. Press Shift NOM. Calculator displays J12 7.869836%. Step 2. Calculate the monthly periodic interest rate. Press RCL button and then IYR divided by 12 to divide the annual nominal rate by 12. Calculator display 0.65582% or 0.065582 as a decimal. Step 3. Calculate the monthly interest payment. Enter $450,000 times 0.065582 to calculate the monthly interest payment. Result: $2,951.19. Therefore, correct answer is A, $2,951.19. The monthly interest-only payment is $2,951.19. Note: with an interest-only loan, all periodic payments until the end of the term of the loan are interest payments and are identical. The monthly interest-only payments are $2,951.19. Question 35. A seller is willing to sell his house by way of a take-back mortgage for $90,000. The seller demands 24 monthly payments and payment of the outstanding balance in the amount of $75,000 with the 24th payment. The seller wishes to earn an effective annual rate of 15% on his money. What is the monthly payment required? Question. Objective. Calculate the monthly payment required based on the loan terms and an effective annual interest rate of 15%. Step 1. Convert the effective annual rate, J1 equals 15%, to the nominal monthly rate, J12. Enter 15, shift NOM, effective annual rate. Enter 1, shift PYR, 1 compounding period per year. Press shift effective to confirm the effective annual rate. Display 15%. Enter 12, shift PYR, 12 compounding periods per year. Press shift NOM to calculate the nominal monthly rate. Display J12 equals 14.0579%. Step 2. Calculate the monthly payment. Enter 90,000 PV, loan amount. Enter 75,000 plus and minus sign and press FV, balloon payment at the end of 24 months. Enter 24N, number of monthly payments. Enter 14.0579 IYR, nominal monthly interest rate. Press PMT to calculate the monthly payment. Display $9,599.22. Result: the monthly payment required is $1,599.22. Correct answer C, $1,599. Question 36. A mortgage loan has a face value of $315,000, an interest rate of J2 equals 4%, an amortization period of 20 years, a term of 5 years, and an option to make accelerated biweekly payments. What is the amount of the accelerated biweekly payment rounded up to the next highest dollar? Objective: calculate the accelerated biweekly payment, which is half of the regular monthly payment, and round it up to the next dollar. Step 1. Convert J2 equals 4% to the nominal monthly rate J12. Enter 4, NOM, nominal semiannual rate. Enter 2, shift PYR, 2 compounding periods per year. Press shift effective to calculate the effective annual rate. Display 4.4%. Enter 12, shift PYR, 12 monthly compounding periods per year. Press shift NOM to calculate the nominal monthly rate. Display J12 equals 3.96708%. Step 2. Calculate the regular monthly payment. Enter 315,000 PV, loan principal. Enter 240N, 20 years times 12 months. Enter 3.967068 IYR, nominal monthly interest rate. Enter 0 FV, loan balance at the end of the amortization period. Press PMT to calculate the monthly payment. Display -1093.38. Step 3. Calculate the accelerated biweekly payment. 1. Divide the monthly payment by 2. Enter 1903.38 divided by 2. Display 951.69. 2. Round up to the nearest dollar. Result 952. The accelerated biweekly payment is $952. Correct answer A, 952. Question 37. A mortgage loan has a face value of $350,000, an interest rate of J2 equals 5.5%, an amortization period of 20 years, a term of 3 years, and an option to make accelerated biweekly payments. What is the amount of the accelerated biweekly payment rounded up to the next highest dollar? Objective: calculate the accelerated biweekly payment, which is half of the regular monthly payment, and round it up to the next dollar. Step 1. Convert J2 equals 5.5% to the nominal monthly rate J12. Enter 5.5, shift NOM, nominal semiannual rate. Enter 2, shift PYR, 2 compounding periods per year. Press shift effective to calculate the effective annual rate. Display 5.575625%. Enter 12, shift PYR, 12 monthly compounding periods. Press shift NOM to calculate the nominal monthly rate. Display J12 5.438018%. Step 2. Calculate the regular monthly payment. Enter 350,000 PV, loan principal. Enter 240N, 20 years times 12 months. Enter 5.438018 IYR, nominal monthly interest rate. Enter 0 FV, loan balance at the end of the amortization period. Press PMT to calculate the monthly payment. Display -2,395.37. Step 3. Calculate the accelerated biweekly payment. Divide the monthly payment by 2. Enter 2,395.37 divided by 2. Display 197.69. Round up to the nearest dollar. Result 198. Question 38. With a constant payment mortgage that is written for $48,951.77 and specifies payments of $548.91 per month for 15 years, what is the approximate interest rate on this mortgage? Objective. Determine the nominal annual interest rate compounded semi-annually I2 that matches the mortgage terms. Step 1. Set up payment frequency. Enter 12, shift PYR, 12 monthly payments per year. Step 2. Enter known values. Enter 48,951.77 PV, present value of the loan. Enter 54891 plus and minus sign and press PMT, monthly payment. Enter 180N, 15 years times 12 months. Enter 0 FV, future value is 0 at the end of the mortgage. Step 3. Calculate the nominal monthly interest rate. Press IYR to solve for the nominal monthly interest rate. Display 0.756093%. Step 4. Convert the nominal monthly interest rate to an annual rate. Press Shift Effective to calculate the effective annual rate. Display 11.302522%. Enter 2 Shift PYR, 2 compounding periods per year. Press Shift NOM to calculate the nominal semi-annual rate, J2. Result: the nominal annual interest rate compounded semi-annually is approximately 11%. Correct answer D, 11% per annum, compounded semi-annually. Question 39. A mortgage loan has a face value of $370,000, an interest rate of J2 equals 5.5%, an amortization period of 20 years, a term of 3 years, and an option to make accelerated biweekly payments, rounded up to the next highest dollar. If this option is exercised, what is the outstanding balance owing at the end of the 3-year term, rounded to the nearest dollar? To solve for the outstanding balance owing at the end of the term, first determine the monthly payment under the loan. Take of that monthly payment as the accelerated payment. Then change the interest rate to an equivalent J26 rate, and using of the regular monthly payment, solve for the outstanding balance at the end of the term. Step 1. Convert nominal interest rate J2 equals 5.5% to effective annual rate J12. Press 5.5 Shift NOM. Press 2 Shift PYR. Press Shift Effective. The display shows 5.75625% effective annual rate. Press 12 Shift PYR. Press Shift NOM. The display shows 5.43818%. J12 equals 5.438018 nominal monthly rate. Now let's determine the monthly payment. Enter 370,000 PV, present value of the loan. Enter 240N, 20 years times 12 months. Enter 0 FV, future value is 0 at the end of amortization. Press PMT to calculate the monthly payment. Calculator displays 2532.24768 monthly payment. Step 2. Calculate the accelerated biweekly payment. Divide the monthly payment by 2. 2,532.25 cents divided by 2 equals 1,266.12 cents. Round up to the next dollar, the accelerated biweekly payment is 1,267ers. Step 3. Determine the equivalent J26 rate. Press 5.5, Shift NOM. Press 2, Shift PYR. Press Shift Effective. The display shows 5.575625% effective annual rate. Press 26, Shift PYR. Press Shift NOM. The display shows 5.43139%. That is, J26 5.431399 nominal biweekly rate. Step 4. Calculate the outstanding balance after 3 years, 78 biweekly payments. Press 1, input 78, shift amort, and then press equal sign 3 times. The calculator displays 328,192,437,346. Result: the outstanding balance owing at the end of the 3-year term is $328,192, rounded to the nearest dollar. Correct answer C, $328,192. Question 40. A nominal interest rate of 8% per annum, compounded semi-annually, is not equivalent to which of the following? 8. Shift NOM2, Shift PYR, Shift Effective. Calculator display 8.16. Effective annual rate matches option A. Continuing the calculation, the J12 rate is calculated as follows. 12, shift PYR, shift NOM. Calculator display 7.869836, compounded monthly. Therefore, the given option C is 4.85%, which does not match. Continuing the calculation, the J65 rate is calculated as follows. 365, shift PYR. Shift NOM calculator display 7.844986, compounded daily matches option D. Continuing the calculation, the J4 and IQ rates are calculated as follows. 4, shift PYR. Shift NOM calculator displays 7921561 divided by 4 to get the quarterly payment. Calculator displays 0198039, which matches option B. Final answer, option 0.85% per annum, compounded monthly, is not equivalent. Question 41. Calculate the monthly payment required for the following mortgage. Principal of $40,000, 14% per annum, compounded semi-annually, amortization period of 20 years. Find the monthly based on the terms of the contract. Step 1. Convert nominal rate J2 equals 14% to effective annual rate J12. Press 14 shift NOM. Press 2 shift PYR. Press shift effective. 12 shift PYR. Shift NOM. The calculator displays 1449, that is, J12 equals 14.49. Step 2. Calculate the monthly payment. Enter 40,000 PV, principal equals 40,000. Enter 240 N, 20 years times 12 months, amortization period. Enter 0FV, future value equals 0. Press PMT to compute the monthly payment. The display shows -486.07037, monthly payment 486.07. Therefore, the correct answer is B, 486.07, monthly payment. Question 42. Given a nominal rate of interest of 5%, if the frequency of compounding increases, what is the result? Correct answer, C. The yield to the lender increases. Explanation. Increasing the frequency of compounding increases the yield to the lender because the effective annual rate rises. A nominal rate of interest of 5% compounded annually results in a 5% return at the end of the year for a $100 investment. If the same nominal rate is compounded more frequently, such as semi-annually, the rate per period is reduced, but the overall yield, effective annual rate, increases. For example, if compounded semi-annually, the yield becomes $506025, which is a 5.25% effective rate. Question 43. A $170,000 mortgage loan written at a nominal rate of 7% per annum, compounded annually, has a 2-year contractual term. Payments are made monthly and are based on a 20-year amortization period. Payments are rounded to the next higher dollar. What is the size of the required payments? Objective. Calculate the required monthly payment for the mortgage, rounded up to the nearest dollar. Step 1. Convert nominal rate J1 equals 12% to effective monthly rate J12. 7 shift NOM 1 shift PYR. Shift effective 12 shift PYR. Shift NOM. The calculator displays J112 6.784974. Step 2. Calculate the monthly payment using the formula. Enter the following values into the calculator. 170,000 PV 240N, 20 years times 12 months. 0 FV, 0 future value. Press PMT to compute the monthly payment. Calculator displays 1,296 with 607. Step 3. Round to the next higher dollar. The rounded monthly payment is $1,297. Result, the required monthly payment 97. Correct answer, D, 1,297. Question 44. A borrower has arranged a $159,000 mortgage at J2 equals 12% with a 20-year amortization, 5-year term, and monthly payments. If all payments are paid when due, how much principal was paid off during the 5-year term? Round your final answer to the nearest dollar. The question wants us to find the amount of principal that has been paid off during the 5-year term. Step 1. Convert nominal rate J2 12% to effective annual rate J12. 12. Shift NOM 2. Shift PYR. Shift effective. 12 shift PYR. Shift NOM. The calculator shows 11.7153. That is J12 11.71053. Step 2. Calculate the monthly payment using the formula. 159,000 PV 240 N 20 years times 12 monthly payments amortization period 0 FV. Press PMT to compute the monthly payment. The monthly payment is 1,718,48792. Enter 78.75 plus and minus sign and then press PMT to round off the payment. Press 1. Input 60. Shift Amort. The calculator shows per 1-60. Press equal sign once. Calculator displays 13,541.84 of principal paid off. Result: the amount of principal paid off during the 5-year term is 13,542. Correct answer B, 13,542. Question 45. Fancy Finance Corporation has agreed to advance $370,000 to a real estate developer by way of an interest-accruing loan. If Fancy Finance Corporation wants to earn an effective annual rate of 6% on the funds advanced, question 46. A private investor expects to receive $281.72 per month for a period of 17 years as a result of a mortgage loan recently advanced for $21,000. Calculate the investor's expected yield, expressed as a nominal rate with semi-annual compounding, on this investment. Round your final answer to 2 decimal places. 12. Shift PYR, 21,000, plus and minus sign, PV. 281.72, PMT. 2024, N 17 years times 12 monthly payments, 0 FV. Press IYR calculator displays 14.771281, that is JJ 1214771281. Shift effective. Calculator displays 15.13514, that is J1 15.1354. 2 Shift PYR, Shift NOM. Calculator displays 15.233374, that is J equals 15.23374. The investor's expected yield, expressed as a J2 rate, is 15.23%. Question 47. What is the amortization period of a $125,000 loan that has a term of 7 years, an interest rate of 6.5% per annum, compounded semi-annually, and monthly payments of $926? Round your final answer to 2 decimal places. To determine the amortization period for the loan, convert the annual interest rate, compounded semi-annually, to an annual rate, compounded monthly. Then, calculate the amortization period. Convert the nominal annual interest rate compounded semi-annually, J2, to a nominal annual rate compounded monthly, J12. Enter 6.5 and press Shift NOM. Enter 2 and press Shift PYR. Press Shift Effective. Calculator displays J186.605625. Enter 12 and press Shift PYR. Press Shift NOM. Calculator display J12 equals 6.413688%. Calculate the amortization period. Enter 125,000 PV, present value of the loan. Enter 926 and press plus and minus sign, then press PMT. Enter 0 and press FV. Future value is 0. Press N to calculate the amortization period. Calculator displays 239.8329 months. Correct answer C, 239.80 months, rounded to 2 decimal places. The amortization period is approximately 239.80 months. Question 48. An agreement for sale in the amount of $150,000 requires the buyer to make payments of $1,250 per month for as long as necessary to fully amortize the loan at 8% per annum, compounded semi-annually. How many full payments of $1,250 will be required? Convert the nominal annual interest rate compounded semi-annually, J2, to a nominal annual rate compounded monthly, 12. Enter 8 and press Shift NOM. Enter 2 and press Shift PYR. Press Shift Effective. Calculator display J1 equals 8.16% effective annual rate. Enter 12 and press Shift PYR. Press Shift NOM. Calculator display J12 7.869836%. Final step. Calculate the number of full payments required. Enter 150,000 and press PV, present value of the loan. Enter 250 and press plus and minus sign, and then press PMT. Enter 0 and press FV, future value is 0. Press N to calculate the number of full payments. Calculator display 236.56675, rounds to 236 full payments. Correct answer A, 236. There will be 236 full payments of $1,250 and one smaller final payment. Question 49. A borrower wishes to make payments of no more than $500 per month for 360 months. If interest rates are currently 10.5% per annum, compounded semi-annually, what is the maximum amount that should be lent, rounded to the nearest dollar? Convert the interest rate compounded semi-annually, J2, to the interest rate compounded monthly, J12. Enter 10.5 and press Shift NOM. Enter 2 and press Shift PYR. Press Shift Effective. Calculator display J1 equals 10.775625%. Enter 12 and press Shift PYR. Press Shift NOM. Calculator display J12 equals 10.277418%. Step 2. Calculate the present value maximum loan amount. Enter 500 and press plus and minus sign, and then press PMT monthly payment. Enter 360 and press N, 360 months. Enter 0 and press FV, future value is 0. Press PV to calculate the present value, maximum loan amount. Calculator display, PV equals 5567.57795. Round the result to the nearest dollar. PV equals 55,067.59795. Rounds to 55,671. Correct answer, C50 of 271. Question 50. A mortgage loan created 5 years ago was originally in the amount of $25,500. The contract called for interest at the rate of 9% per annum, compounded semi-annually, and constant monthly payments of $219.39. Calculate the outstanding balance due immediately after the 36th and the 60th monthly payments have been made. Round your final answers to the nearest dollar. Convert the nominal annual interest rate compounded semi-annually J2 to the nominal annual rate compounded monthly J12. Enter 9 and press Shift NOM. Enter 2 and press Shift PYR. Press Shift Effective. Calculator displays J1 equals 9.2025%. Enter 12 and press Shift PYR. Press Shift NOM. Calculator display J12 8.835748%. Step 2. Set up the loan parameters for amortization calculations. Enter 25,500 and press PV, loan amount. Enter 219.39 and press plus and minus sign, and then press PMT, monthly payment. Enter 0 and press FV, future value is 0. Enter 36 and press Input Shift Amort for the outstanding balance after 36 payments. Step 3. Calculate the outstanding balance after 36 payments. Press equal sign 3 times to calculate the outstanding balance. Calculator display 24,155,6745, rounded to 24,202. Step 4. Calculate the outstanding balance after 60 payments. Enter 60 and press Input Shift Amort for the outstanding balance after 60 payments. Press equal sign 3 times to calculate the outstanding balance after 60 months. Calculator display 23,456,4546, rounded to $23,125. Final answer. The outstanding balance after 36 payments is 24,202s, and the outstanding balance after 60 payments is 23,125. Correct answer B, 24,202 and 23,025. Question 51. Assume that you have a $100,000 mortgage loan at a rate of 10% per annum, compounded semi-annually over a 5-year amortization with monthly payments. If the amortization period of a loan is increased to 10 years and the remaining loan terms are unchanged, which of the following is true? Lengthening the amortization period means that more time is allowed for the borrower to pay off the loan. For constant payment mortgage loans, the initial first payments are composed of a greater portion of interest, whereas the last payments are composed of a greater portion of principal payments. Below is an example demonstrating changes in amortization. This example has a 5-year amortization period. Calculate OSB 24. Step 1. 5-year amortization. Calculate OSB at 24 months. Enter 10 and press Shift NOM. Enter 2 and press Shift PYR. Press Shift Effective. Calculator display J1's 10.25%. Enter 12 and press Shift PYR. Press Shift NOM. Calculator display J12 eats 9.797815. Enter 60 and press N, 5 years times 12 months. Enter 100,000 and press PV. Enter 0 and press FV. Press PMT. Calculator display 9 is 214769835, rounded to 114.77. Enter 2144.77 and press plus and minus sign, and then press PMT, rounded payment. Enter 24 and press Input Shift Amort. Press equal sign 3 times to calculate OSB. Calculator displays 65 Vow 732.53034. Step 2. 10-year amortization. Calculate OSB at 24 months. Enter 120 and press N, 10 years times 12 months. Press PMT to calculate the new payment. Display $1,310.34. Enter 24 and press Input Shift Amort. Press equal sign 3 times to calculate OSB. Display $89,123. As in the example above, increasing the amortization period will increase the OSB at time 24. Therefore, option 2 is correct. Your payments have decreased and you are stretching out the time needed to pay off the loan. You are paying more interest, and since interest is paid more at the beginning than at the end of the loan, your payments on principal are delayed. Therefore, Therefore, at each point in time, the amount outstanding on your principal will be greater. Question 52. With fully amortized constant payment mortgages, when payments are rounded up to the next higher dollar, what is the impact on the number of payments necessary to repay the loan amount? Option 1 is correct because if the payment is rounded up to the next higher cent, the final payment of a fully amortized mortgage will be smaller than regular payments because the borrower is overpaying a slight amount each period. Options 2, 3, and 4 are incorrect for this reason. Explanation: correct option A. Rounding up the periodic payments slightly reduces the principal balance more quickly. This results in 1. Fewer total payments required to repay the loan in full. 2. A reduced final payment, as the loan is paid off before the last regular payment would have been necessary. Incorrect options: B. Payments rounded up do not increase the number of payments or the final payment size. Instead, they decrease them. C. Payments rounded up shorten the amortization rather than matching or increasing the term. D. The effect of rounding up can be determined. It shortens the repayment schedule and reduces the final payment size. Conclusion: the correct answer is A. They may decline in addition to reducing the size of the final payment. Question 53. A borrower wishes to make monthly payments totaling no more than $625 per month for 300 months. If interest rates are currently 10.5% per annum, compounded semi-annually, what is the maximum amount that should be lent, rounded to the nearest dollar? Objective: calculate the maximum loan amount, PV, that allows for monthly payments of $625 for 300 months at an annual interest rate of 10.5%, compounded semi-annually. Step 1. Convert the nominal annual rate J2 to the monthly rate J12. Enter 10.5 and press Shift Nom. Enter 2 and press Shift PYR. Press Shift Effective. Calculator displays 10.775625%. J1's 10.77625%. Enter 12 and press Shift PYR. Press Shift Nom. Calculator display 10.277418%. J12's 10.277418%. Step 2. Calculate the present value PV. Enter 625 and press plus and minus sign and press PMT, monthly payment as a negative value. Enter 300 and press N, 300 months, which equals to 25 years. Enter 0 and press FV, loan is fully amortized. Press PV to calculate the loan amount. Calculator display 67,325.219664. Result: the maximum amount that should be lent is $67,325, rounded to the nearest dollar. Correct answer B, 67,000. Question 54. A private investor expects to receive $281.72 per month for a period of 17 years as a result of a mortgage loan recently advanced. Calculate the investor's expected yield, expressed as a nominal rate with semi-annual compounding, on this investment if the loan amount was $23,250. Round your final answer to 2 decimal places. Question objective. Determine the nominal annual interest rate compounded semi-annually J2 based on the loan details and payment terms. Step 1. Input the loan details to calculate the nominal monthly rate, J12. Enter 12 and press Shift PYR. Enter 23,250 and press plus and minus sign and then PV, loan amount as a negative value. Enter 281.72 and press PMT, monthly payment. Enter 204 and press N, 17 years times 12 months. Enter 0 and press FV, loan is fully amortized. Press IYR to calculate the nominal monthly rate, J12. Calculator displays 12.89841%, that is J12's 12.89841%. Step 2. Convert J12 to J2, nominal annual rate compounded semi-annually. Press Shift Effective. Calculator display 13.688927%, that is J1 and 13.688927. Enter 2 and press Shift PYR. Press Shift Nom. Calculator display 13.2502%, that is J1 13.252. Final result: the expected yield, expressed as a nominal annual rate compounded semi-annually, is 13.2 founded to 2 decimal places. Correct answer D, 13.25%.